Hey everyone, as promised in our daily financial news, we are going to be speaking with Jonathan Twombly today as a part of our expert series. How you doing, Jonathan?
I'm great, Michael, and I really missed last week, so sorry about not being able to be on that call. But I was up closing my new house upstate and taking care of that stuff. So
Yes, well, that's all right. You're allowed to have a busy life. It's okay. You're taking advantage of some pretty good things. So maybe we'll get into that in a minute, folks. Just so you know, we're gonna actually have three topics with Jonathan today. We're gonna break them into three different sections. First and foremost, we're gonna talk about his multifamily launchpad. He just had his mastermind event yesterday, which was awesome. Then we're going to talk about the economic data of the day, unemployment, GDP, stimulus. And then finally, we're going to close with where are the opportunities in the future, right? We're going to talk about the big boys and mom and pop. So lots of stuff with Jonathan today. Please pay attention. But Jonathan, let's talk about the mastermind event, which is a part of the multifamily
multifamily launch.
launchpad, which is a quarterly event. It's something that's fantastic.
Yeah, so I mean, I didn't really intend to do this as like a plug of the mastermind, but because I wanted to talk about it because we had we had six great guests yesterday, ranging on all, we had topics ranging from how to do single family vacation rentals, why that's a hot topic right now, what's going on because of COVID, it's really benefiting. We talked about how to build a portfolio without syndicating. We talked to Ryan Severino, who's the chief economist of Jones Lang LaSalle, with James Ang of Old Capital about what's going on in the capital markets. We talked with, got two more people on there, slipping my mind. I have my list here. We talked with Ted Lanzaro, who's a CPA, about what's going to happen to your taxes as a result of the election. That was a really hot topic. I mean, talking about, they've been talking about the 1031 disappearing if Biden's elected. We kind of put that to the test. Put a bunch of other, things that are scary to real estate investors to the test. And, we had a great conversation about that. And we also had Paul Moore come on and talk about how you raise a fund, which is, I know, a topic of interest to a lot of people. But the reason I wanted to talk about this was because, in particular, Ryan Severino, who's an economist at Jones Lang LaSalle, and James Ang, who's like just in the thick of it because he's a really, really active mortgage lender. Really had some interesting insights about where the economy is, what the multifamily market looks like. And I just wanted to talk about that a little bit because I thought, you guys would like to hear this information. And if you want to watch the full interviews, the whole 6 hours of this, you can still buy the videos. We'll put the link up in the show notes after. I don't know the URL off the top of my head, but you can still get the videos if you want. $97, great deal for all this knowledge. So anyway, so what Ryan Severino, his real takeaway point was that the recession is the coronavirus. The recession is the pandemic. And he said the issue with the economy right now is that at the end of the day, people are not doing stuff that they normally do because of the pandemic, because they're concerned about getting sick. And now we had said earlier on in this whole, event, there was a supply side shock when everything got shut down. So the economy had basically the supply dried up for most goods and services, except for essential ones. So the economy took a huge hit because of that. However, that has basically all been turned back on, almost all of it. And what is the residual that's still lingering is the fact that people are not traveling, they're not going to their offices, they're not going about their daily lives in the way that they used to be because of coronavirus. They don't want to get on planes, they're not going to go to movie theaters, they don't want to go to restaurants, that kind of stuff. So they've really altered their spending habits because of this. So, that actually dovetails really nicely into the presentation by Anna Kelly about vacation rentals, because one of the effects of COVID has been that people are staying closer to home. They're going on driving vacations. And if you can get your hands on vacation rentals in places that are either highly popular on their own as a kind of a not staycation, but as a easily accessible vacation that doesn't involve flying, or someplace that is a vacation area that's within a driving distance of a major metropolitan area. There was a briefly back when Corona started, there were a lot of cancellations, people freaked out, but then it just ramped up like crazy.
Yeah.
And the demand was off the charts for vacation rentals. And that's kind of the same thing that Ryan Severino, it's an effect of what Ryan Severino is talking about, the change in consumer habits because of this. So, but again, I just thought that his point was so, I like sort of intuitively understood this, but for him to say the recession is the pandemic and the pandemic is the recession was just, I think if people don't really get that, they're really not going to understand where we are in the economy now and what the trajectory of the recovery is going to look like. And a couple of interesting charts that he put up. One was your favorite, the K-shaped recovery. He's like, very much, into that. And the thing that was interesting about the K-shaped recovery was, and I hadn't seen anybody really lay it out this way before, but when you've got the 3 prongs of the K, or actually really the way he did it is sort of 4. There's the straight up is people who were just like their businesses have just boomed because of COVID.
Mm.
Straight down is the people who have just been like really screwed immediately because of COVID. Then the upward sloping portion is the people who are basically back to normal because they have jobs that can be done from home and they depend on technology. And the sloping downward is the people who are like slowly getting killed because their jobs have been just like eroding away because of COVID. So that was really interesting, but also in the sort of GDP growth trend part of the recovery that he talked about, it's a very clear square root, function. It's quick bounce back. And he talked about how, we had the worst recession of all time, and and Q3 is going to look like the greatest recovery in the history of man. And you and I both, we predicted exactly this months ago.
Months and months ago.
And believe me, as soon as the data comes out for the third quarter, the politicians are going to be claiming all kinds of credit for all, but think about it, all they did was just turn the economy back on. And of course you're going to have a huge bounce back, but it's a bounce back to only a point.
Yeah.
And then it's a slow haul back. And so they're not predicting the economy, at least Ryan is, and he's a really good economist, not predicting the economy to return to normal until about 2023. I would like to hit where we were.
Wow, 2023. So 2019 GDP totals doesn't 2023 4 years.
I think so. It was either 2022 or 2023, but it's not. I mean, it's a slow grind. It's a slow grind back.
Yeah, that last 10% is tough.
Yeah, and he talked about the economists. The Economist magazine, their metaphor of the 90% economy, right? That's kind of like we're just, he said it's not precisely 90%, but it's a good way of thinking about it. That basically we bounce back to 90% of where we were, but that last 10% is all the stuff that people can't do, or
can't do, won't do,
can't do or won't do because of COVID. So that was one really interesting point. Then the other really interesting thing that I want to highlight was James Eng's presentation about the lending environment. And actually, before we get there, one other thing that was interesting about Ryan Severino, and this was really helpful because of stuff you and I talk about all the time, which was millennial home buying.
Yeah.
And what he was saying, and this is, I was so happy to hear this because Ryan came on and he was like, since 2015, I've been saying this whole idea that millennials don't want to own homes. It's just BS.
Yes.
They want to own homes, but they couldn't because the market had basically seized up after the great financial crisis. It got hard to buy a home. People weren't putting homes on the market. There wasn't enough supply. You couldn't get a mortgage. As soon as things started loosening up in 2016, you saw the home ownership rate start ticking back up again. And that was the millennials finally having, the cork pulled out of the bottle.
Mm-hmm.
And so, but now what's happened is basically because of COVID, all the people who were sitting on the fence, all the people who had that pent up demand, all the people who were going to move anyway, now it's just all happening at once.
Yeah.
So the interesting thing, and this is just like how you have to understand economic data, right? people have this tendency to take a snapshot of where we are and extrapolate it into the future forever and decide this is, and because of that, they make investment decisions and they make bad ones sometimes.
Yeah.
So the bad extrapolation of data from 10 years ago was millennials don't want to own homes. I mean, so actually what it was millennials are not buying homes, right? And then the logical leap was because they're not buying homes because they don't want to buy homes.
Right.
And because they don't want to buy homes, they will never want to buy homes.
Yep.
And so they're going to rent forever, right? That was the logical chain.
Yeah, that is going to prove to crush some people.
Yeah. So, and that's why multifamily development just ramped up like crazy, especially in the core areas where the millennials were living because they were young and they wanted to like go out and have fun and meet the opposite sex and whatever, right? So, but as they were aging, they were stuck because they couldn't qualify for mortgages or whatever the reason was, right? So now what's happened is we've had 10 years of pent up demand and suddenly COVID has pushed it over the edge. So all of that pent up demand is all happening now, right? And again, people are going to they're going to draw the wrong conclusion from this rather than looking at this thing over, say, like a 30 or 40 year time horizon and seeing, oh, this is just reversion to the mean, which you have to overcorrect to get back to the mean, right? So rather than looking at it over the long view and saying, oh, this is just what we expected to happen anyway, it's just being compressed. Now what they're saying is, oh, everyone is fleeing the cities. Nobody wants to live in the cities anymore. Probably the same people who said people only want to live in the cities. The suburbs are dead. Like those same people are now turning around saying the cities are dead. The suburbs is where it's going to happen. Nobody's ever going to live in a city again. And like, none of that is true, right? If you look at the snapshot, it'll mislead you. Yeah. Now, as you and I have talked about before, there are short-term investable trends,
sure,
right? And so like a short-term investable trend right now is, go buy, beat up houses in the suburbs and flip them to these people who now suddenly, have like they've been pushed over the edge by COVID, plus interest rates are super low. So, that is an investable thing,
no question.
But the idea that like that no one is ever going to live in a city again, so you should sell all your holdings in the city or like never buy in the city again, that is not realistic. In fact, what you should be thinking about is, gosh, all these other people around me are going to be taking the wrong conclusion from this. There's going to be a lot of fear. That means cheap assets, right? That means bargains.
And that's what I want to talk about in our third conversation today is where to look. And it's always where people are running from.
Yes.
Right. The lemmings are real. The population. I mean, it's amazing if you pay attention and you stay measured and you don't let your emotions get away from you. You really can watch. You can just watch it all happen. It's like a movie. It's pretty fun to watch.
With the caveat, though, that I think, again, long-term trend, look at the long-term trends, because if you have long-term trends of population decline, that's telling you something else.
That's different.
Right? Yes. That's different from like a short burst of like panic-induced buying, right? Totally agree. So those are two different things. We'll talk about that later. Now, going back to James Zhang. So James was talking about the multifamily lending environment and was talking about how in the third quarter, there was just record deals on the market. There were a ton of deals on the market.
Really?
And the reason, again, was because the market ground to a halt because of COVID. And so there was all this pent up, everything that people were planning to bring to market didn't go to market. But then what happened was when collections were still good because of all of the government stimulus and the fact that like people like you and I continued to just work as normally and what have you, people at the upper end of the income scale were still fine paying their rent. People at the lower end were getting government support to help them pay rent. When all the stats came out, and it looked good, all of those sellers said, now's the time to sell before bad data starts coming out. So a record number of deals came to the market, apparently.
Interesting.
But it also really depended on your market, which market you were looking at. I didn't see as much, but I heard other people in my Facebook group saying, God, like, where are all these deals coming from? Suddenly my
Where'd the
inbox is
supply come
flooded.
from?
Yeah. And again, it's because of the lumpiness, right? It's because the stuff that didn't come out before suddenly came out. Plus, I think some people who were on the bubble about selling, thinking like, gosh, now is the time to get out and pass this on to some sucker before the bottom drops out. And so interestingly enough, we haven't really paid attention to this over the last month, I think just because I've been busy with other things. The collection, as we expected it would with the government support, drying up. So people did bank a lot of that money. They put a lot, because they got paid so much money, and they did the sort of economically rational thing, which was, boy, I'm getting more money than I expected, but I know that this is time limited, so I'm going to bank as much of it as I can, and that has allowed them to carry over a couple of months with rent payments. But now we're starting to see the erosion, and what's happening in the lending environment is that the lenders are no longer looking at T3 data or T12 data. They're looking at the T1 data. T1 is trailing 1 month.
Yep.
They're looking at the trailing 1 month data because that is the most up to date about collections. And that is affecting now the proceeds that you can get for a loan. So it hasn't now. So what's happened now is people are still overpaying for deals. The cap rates are super compressed. James made a great point about, he said in Dallas, you can buy a Class A property for 4 cap, a B for 4.5, and a C for a 5 cap. And
oh my goodness.
If that's the situation, you want to be buying A's because you're not getting any risk premium for a C, right? At 1% difference in cap rate, right?
Yeah, for sure.
And so, so you've got like people, there's fairly, the supply is limited, even though a record amount of deals came on. Not as much as what people want. The demand is still really high. There's money coming in from other sectors that used to buy hotels and retail and stuff. They're all flooding into multifamily. They're keeping the prices up. The cap rates are really compressed. But now we're kind of running into this like buzzsaw where the proceeds you can get are going to be less. So you're gonna have to raise more equity for a more expensive deal so you can get to the level of, they're not necessarily, you might be in a program that says we will lend 75%, but then it's DSCR constrained because you can't hit your 1.25. So you might only get 68% proceeds. And I've seen this on deals I've been looking at. I send them to my mortgage broker and he's like, okay, this is an 80% LTV program I can get you into, but we can only get you 67% LTV because of the DSCR coverage. So that means you're raising a lot more equity. Now, a lot of people are happy to do that because they're looking around the world and saying, well, where else am I going to get 4%, right?
True.
That's fine if you can guarantee that you're going to continue to get 4%. I think the issue is, where do rent collections go and where do cap rates go? And if there's inflation, interest rates will go up. That'll cause cap rates to go up. So that'll, ruin your exit or ruin your refi. So, I mean, we're still in this weird sort of top of the market situation with multifamily real estate, with an economy that's not so great,
right?
And it's only slowly recovering at best. And depending on your asset class, you may be at more risk than others. And as you've said before, we've both talked about this many times, your A-class renters, if that building is not seasoned, right? If this is a lease up situation or, whatever, if that's on a seasoned building that has, it's 92, 93% occupancy kind of locked in, and like, you're not, you can refill a few apartments if you need to, that Class A renter, they're looking at, 3% mortgage interest rates and saying, do I really need to be paying rent?
Exactly.
And your C-class renter, well, that unemployment supplemental just ran out, and obviously a lot of them still have jobs, but a lot of them don't. Your occupancy is not going to be as high as you expect. So, and your collections are going to be weak. So these are things that you need to consider. So anyway, that was a very long-winded kind of summary of what happened yesterday, but it was a really great day. And as I said, if you'd like the videos, we'll put the link up and you can still buy them. So
absolutely, folks. I would recommend $97, 6 hours of material every quarter, rock star analysts quoted all over the media. And again, you are getting to see what is really going on. Jonathan and I talk to you every week, but to get these 6 individuals talking about what's going on, whether it's vacation rentals and what happened there with Anna, just a total surprise, right? February or March, we're like, oh, get away. Airbnb's out of here. Everybody's going to go broke. And all of a sudden, you know what? Staycations, driving. And oh, by the way, people would rather do Airbnb versus hotel. I didn't see that coming.
Exactly. That's another point that she brought up, which is a great one that, I mean, I've wanted to do Airbnbs over hotels for ages because I've got a family, like it's just more comfortable to stay in a house. We can cook, but with the coronavirus going on, and either you can't go to restaurants or you don't want to go to restaurants, or, the restaurant is at 50% capacity and you go there and there's a line and you can't, you just want to be able to have a kitchen, cook. You don't want to go to a hotel because you don't know who's touching what, even though they've got, they're doing their sterilization and stuff. Like you still just, so Airbnb, I mean, it's where people want to be right now. So
it's very good. And then again, talking with economists about what's going on, the K-shaped economy, understanding what's going on with millennials. It's so awesome to see what you and I talk about every week is bubbling up to the really smart and talented people. So that's wonderful. So,
I mean, we're just so smart, Michael. I mean, we just can't we're just such geniuses at this stuff.
No, man.
Everyone eventually, they eventually catch up with us with the data, but
we I will say we're batting probably 750, 800. We're doing pretty well. I will admit to that.
We're doing okay. Yeah. And I just want to make one more point too, that, this Mastermind Day, you can always buy tickets for it and buy the videos, but it's actually a perk you get for free if you're a member of Multifamily Launchpad. So, if you're a member and you're current, and you're paid up, you get this 4 times a year for free. So.
Yeah, folks, you need to join Multifamily Launchpad. Getting at these mastermind events for $97 may be a test, but Jonathan puts out amazing stuff. I've seen the feedback from his students. You really need to check out Multifamily Launchpad. Jonathan, I want to thank you for this episode. I look forward to number 2.